Hello and welcome to the channel. If you're new here, thanks for joining us, and if you've been here before, thanks for coming back. In this video, we conduct a case study on the E-mini S&P 500 futures. We arrive at some interesting results that lead to a new hypothesis to test.
So let's get into it. So we have our ADX momentum foundation loaded. If you're new to the channel, a foundation is a pre-engineered system. It's a system that doesn't require you to have to do any coding. You can load it in your Sierra chart platform and instantly begin formulating your ideas and back testing your strategies. So we have the ADX momentum foundation loaded. Let's alter some of our settings and let's set up a back test and check out the results. So I just clicked on studies to pull up this chart studies panel. And then we can see we have our ADX, we have our proprietary machine learning models for volatility and liquidity, and we have our foundation. So then we can just go into ADX by clicking settings here. And I'm thinking instead of doing some type of shorter term trading system, let's do a more longer term system or a medium term system. And let's try to capture medium term trends. So I'm going to change this to about 3 here. And the reason I'm changing this to a shorter time period is because right now we have a shorter look back. Right now we have the 3-minute loaded. We're going to load a different time frame and see can we run some trades. So we changed our ADX. Let's go into our ADX momentum foundation. Okay, so we have our ADX threshold here. This just controls the level in which we want the ADX to be above in order to detect the likelihood of a trend. Let's alter this and let's change our close status to on the close so that we get some confirmation. We do want to use our dynamic risk management, and we're going to turn off our volatility filtering system. So our volatility filtering system is a system that leverages our machine learning models to be able to forecast future volatility. And then based on those forecasts, if we find, for example, that we would like to exploit something that some event that happens when volatility increases or decreases, we can just turn on our volatility filtering and then set the sensitivity for increasing and decreasing. And at that time, our system would only take a trade when those conditions are met. So we're going to turn volatility filtering off, but what we're going to use is our institutional flow system. And this system uses our liquidity machine learning models. Our liquidity models forecast future liquidity. So we're going to use that, but we're going to put the sensitivity down to maybe a medium. Okay, that looks good. Our look back looks good. And then we're going to let's risk maybe 1,200 per day. And then our max give back trigger is okay. This is just the threshold. Once we're up $1,000, if we ever give back 500, we just stop trading. Okay, per trade, we're going to risk 500 per trade. And then we're going to, let's see here, we're going to have maybe a 25 tick stop, and we do want to trail. Our stop here. We'll leave that. Let's increase our target multiple to maybe 12. So our target multiple is just the multiple of our exposure. So we have per trade, we're risking, our exposure is $500. We're risking that amount per trade. So then our target would just be placed 12 times at a level 12 times that $500. Okay, that looks good. Okay. So we can just simply click OK. And then we can see our ADX and we can see, but what we're going to do now, we're not going to trade this on the 3 minute, and let's disconnect from the data feed. We're going to trade this on a different time frame. So let's go to, we can right click and go to chart settings. And we're going to go to bar period, and let's put this on a 15-minute time frame. Because of the way that we're constructing this particular strategy, again, I'm just choosing random values, but theoretically, the way that this strategy is being constructed, we are going to want to change our session time, not just to trade or be limited to trading in the North American session. So I'm clicking or toggling on use evening session because it's likely that we're going to have some overnight exposure. Okay, click OK. So now we are reloading the data. Once the data reloads, we can then bring up our backtest control panel and start our backtest. So to do that, we would just simply click chart here, and we would scroll down to replay chart and replay control panel. And then that will pull up this replay control panel here. So we can bring our speed down to maybe 960. And we see we are replaying a single chart. That's fine. We want to make sure that we're doing accurate trading system backtest. So that looks good. And we're at so let's load a few more days. So I think this may have only just loaded 10 days. We're going to load more data. So let's go back to data limiting. Number of days to load. Let's load maybe 60 days here to start. So I'll let the data load and then we'll come back. Okay, so our data is loaded. One thing that we definitely want to go and check, let's go back into our foundation. And we know we're going to have some overnight exposure. So we definitely want to change our time in force from day to good to cancel to make sure that we have some risk management outside of the regular trading session if we have some overnight exposure. And then we can we'll enter at the close. Limit orders are fine. Okay, this looks good. Okay, now we're ready to start our back test. So we just simply click play, clear all trade data for symbol and account. This is just going to remove the prior backtest data so that once we look at our statistics, we know that it's specific to this most recent test. So we can click OK, and then we can bring up our trade activity log here. So this contains all of our prior backtest information. And then we just want to wait for it to refresh. And once it refreshes, we should see prior test runs, prior data removed. And then I changed this from the Sim 13 to Sim 12 here, which to match this current test. This is a prior test that was run. So once this refreshes, and what precisely that we're waiting on is that if you look here, we have this query counter, and it's just counting the number of background processes that are remaining to just clear out that data. So I'll give it a moment to refresh here, and then we'll start our back test. Okay, so our trade activity log just refreshed, and we can just minimize this for the time being and just press play and start our back test. And then because we're doing 15-minute bars, maybe let's speed it up a little here. Okay, so we can see our models are reading in the market data. We can see the forecast for liquidity as well as the forecast for volatility. And then I'm just going to allow this to run over this 60-day period. And then we'll come back and see, what the results look like. Okay, so our back test just completed. Let's pull up our trade activity log and check the results. Okay, here's our trade activity log. Okay, let's see what happened. Okay, so this implementation wasn't profitable over this 60-day window. Let's see why. So we had an equity peak of 1,300. We had a max run up of roughly 3,000. This equity valley, so we were underwater, and profit factor below 1, 27% profitable. We took 91 trades. Let's see what else do we see. 1.65 average profit factor. Okay, so our average profit factor is significantly higher than our total profit factor. This is a clear sign that the system is taking trades during periods in which it shouldn't be trading. So typically what you should be doing is monitoring when your system is trading. You should always understand what the assumptions and limitations are of the type of system that you're developing. So I watched a few trades that the system took, and some things were pretty evident, which led to me believing that if we place this system on a completely different instrument, something like gold, for example, I would expect it to perform better. Again, we chose random value, so we had no prior knowledge of what the results would be. But just knowing and understanding the instrument and understanding the assumptions and limitations of this type of system, and then just watching it actually take some trades, that's what led to my hypothesis. Because we're trading the E-mini S&P 500. The system has the ability to trade outside of the primary period of, liquidity and volatility. And then it could be that if we back tested this over a longer period of time, maybe the results are better. However, just understanding the market microstructure of the instrument and understanding what the system is assuming and the limitations of those assumptions, there are definitely some things that we want to change about this implementation. It's evident that the system is attempting to enter the market in search of continuation during periods in which it's not likely for the market to actually exhibit that continuation. So there are things that we could actually improve. We could change our trade management. We could also change, we're using institutional flow. So we're using our institutional flow machine learning system. So if we actually didn't have the institutional flow machine learning system, these results would be significantly worse, because that system is going to downsample or filter out some of the noise in the market. So we're using the medium sensitivity on the institutional flow. We could do some other things with respect to our trade management, how we're managing trades. But given this instrument and given the nature of what it is that we're looking for, it's likely this system would do a lot better if we limited the trading sessions in which it was trading. Because from what I witnessed, just periodically glancing at the back test as it was running, is that statistically it's just unlikely to get continuations at certain points in time where there's low liquidity. And then volatility is completely different. Then you have this drastic regime change every day, from going from a pretty quiet state to an extremely high period of high volatility, high liquidity, etc. Sometimes it's beneficial, but looks like the majority of the time it's not, at least with these particular trade management and risk management settings. So we may want to, one thing that we potentially could do is maybe include the volatility filtering, because we know volatility drops outside of the North American cash session. that could be one way that we could improve this to make it better. We definitely want to change our trade management. Otherwise, so there are a few different things. One thing that I did want to point out is that if for any reason you don't recall or you don't understand exactly what a system is doing, what a foundation is doing, what a lot of this stuff means, you can just simply click description here. And what this is going to do is open up a window in your browser, and then you can see the study description, exactly what the system is doing, and then you can just scroll through here and you're able to see what all of these parameters are to confirm your understanding, to give you, to improve your intuition when you're setting the values for these parameters. So this particular foundation is using the ADX, and then you set a threshold, which we set prior to the back test. And then once we're trading above that threshold, and then you get some volume imbalance, and then the returns over our look back period are positive or negative, then we take a trade. So we're looking at a combination of this ADX. We're looking at the returns over some past period, and then we are looking to take a trade and be able to hold it over a significant period of time, at least in this case. And then we used institutional flow, and we also use our dynamic risk management, which directly computes our optimal position size. So in this example, we had a max position size of 2. So then this system, based off of our volatility forecast, it can dynamically adjust our position size so that we're taking the appropriate size for the amount of risk forecast in the market. But this is just an example. There's not enough time in this video remaining to test my hypothesis with respect to gold, but we'll likely create a follow-up video to where we run this exact same system on gold, and we can compare the results on gold to the results here, and test my hypothesis. But I believe just not even changing any of the settings, if simply changing the instrument, could very well yield a better result, at least for initial testing. Because definitely a 60-day in sample period isn't something typically that you would use to validate whether or not you could trade a system, but it's a starting point that you could use to determine and also gain intuition with respect to the parameters, to the settings, the assumptions and limitations of the system, and somewhat calibrate it to meet what your specific goals are. Then you could do a longer back test to really confirm that your system is able to generalize, that you haven't overfit or curve fitted to a specific period. So that will wrap up this video, and thanks for watching.
To get access to the exact no-code systems featured in this video, so you can begin your own experiments, visit the link in the description to learn more about the Strategy Lab. You'll gain access to the system and machine learning models used. Also, if you would like to learn more about how professionals structure their system development, be sure to sign up for our free course, Automated Trading Foundations. The link is in the bio as well. Don't forget to follow us here and on our other social channels to receive additional insights to fast-track your automated system development.